Welcome back to Bazaar Morning Call. Hope you're having a good morning so far. The GIFT Nifty is indicating that the start will be quiet, but we don't mind that. It was a big run-up that the market saw last week, so perhaps some consolidation could be on the cards today, but the momentum is still intact. Avenue Supermarts, however, reported a muted set of numbers. Mangalam is joining in. Mangalam, once again, the margins continue to be under pressure?
The margins continue to be under pressure for DMart, but what's changed from last quarter to this one is the slightly positive management commentary. So let's take these numbers, one by one. In terms of revenues, it was an 18% growth, not too far away from what the street was anticipating, and the company had guided for as well on a standalone basis. 11,865 crores on the top line that the company has posted. But it's the operational performance. Gross margins compressed by about 110 basis points. The EBITDA margins compressed by about 130 basis points year on year. And as a result of which, both the EBITDA and the net profit were below street's expectations and below the expectations of a CNBC-TV18 poll as well. Gross margins at 15.2% compared with 16.3%. The street was working with a number well upwards of 15.5% itself. But now here's where the management commentary change has come about. The first part is that they've said gross margins are lower due to lower contribution coming in from apparel and general merchandise, and this is what we've seen over the last many quarters. However, this time around, the management said that this is improving and trending towards pre-pandemic levels. Remember, pre-pandemic, this was around 27, 28 odd percent, but currently had fallen all the way down to 23%. So let's see how soon it can recover. The other positive was that DMart Ready, the online business, has seen a bit of a ramp up in its quarterly run rate at around 281 crores. So the stock will open in the red, but let's see if there is some demand at lower levels for DMart.
Okay, all right, Mangalam, thanks a lot for that. So that's a bit of a miss in terms of numbers. But Rima joins us to tell us about Just Dial. Rima, those numbers look very good.
Yes, it's a good quarter for Just Dial. Revenues have improved on a quarter-on-quarter basis by 6%. On a year-on-year basis, the company's revenues have been above 30% for the fourth consecutive quarter. And even an indicator of forward revenue, that's deferred revenues, has gone up pretty smartly. Margins have been improving up due to operating leverage, which means better revenue growth. So margins are at a 9-quarter high. They're up 50 basis points quarter on quarter and up more than 10% on a year-on-year basis at 14.9%. The cash on the books has always been the support for Just Dial at more than 4,000 crore rupees at 60% of its market capitalization. The only negative in the numbers is their active paid campaigns. What they sign on as customers who are paid customers, that in the current quarter was slightly lower than the run rate in the prior 2 quarters. But stripped of that, these numbers are looking good. Back to you.
All right, and in fact, we will be joined by Abhishek Bansal, who's the CFO of Just Dial. That happens at 10 a.m. today, so do stay tuned in. We will discuss more about the Q1 performance. But let's get down to the granular details on JSW Energy and how those numbers looked. Vivek is here with more. Vivek, morning.
Well, good morning. JSW Energy, a slightly mixed quarter, muted in terms of top-line growth, especially. Now, what's actually happened is that, multiple factors have gone ahead and offset each other. So the incremental revenue that is coming from Mitra as well as the renewable capacity addition has aided the top line. However, lower coal prices has actually gone ahead and ensured that realizations are low, thereby impacting the top line. So top line on a year-on-year basis fell almost 3.5% lower. EBITDA, however, was up 19.5% on a year-on-year basis on increased contribution from the renewable assets, especially Mitra. Our margins coming in at 41.7% versus 34% on a year-on-year basis. However, when you're talking about the interest cost this time around, multiple one-off effects, but the interest cost for this particular quarter was 486 crore versus just around 193 crore on a year-on-year basis. This was on the back of the Mitra interest cost that saw that the company had to do the acquisition. And lastly, on the back of higher interest costs, profitability was down almost 48.3%. Brokerages at this point of time maintain a sell stance on the back of very high valuation that the company trades at. Elara says that the company trades at almost 29 times FY25 price to earnings and 15.5 times FY25 EB to EBITDA. On the back of that, they maintain a sell stance.
All right, Vivek, thanks very much for that. We'll be, by the way, joined by the management at JSW Energy. Prashant Jain, Joint Managing Director and CEO, will be on the show at 9:30 this morning to discuss the performance in greater detail. Now, Bandhan Bank has also reported numbers, a little underwhelming. Abhishek is here with some numbers to tell you the Bandhan story. Abhishek, morning.
Morning, Prashant. So, stress has risen in the portfolio of Bandhan Bank. Gross NPA ratio has increased to 6.76% versus 4.9% in the previous quarter. Some of the contribution have come in from the recent RBI regulation that the bank has mentioned in their con call as well. Slippages increased to 1,360 crores, which compares to about 1,118 crore in the previous quarter. The EEB book, that is the stress portfolio that they have, that also increased to about 6,200 crore. Versus 5,500 crore in the previous quarter. So it now forms about 6% of the loans versus 5% in the previous quarter. On the positive side, the net interest margin has remained stable at about 7.3%, which is flat on a sequential basis. However, PNL is below our pole, both in terms of NI and PAT as well. And we are seeing some of the brokerages cut their target price on Bandhan Bank like JP Morgan, Nomura, Jefferies and CLSA. Back to you.
Okay, thanks a lot for that, Abhishek. We'll also be joined by Mr. Chandra Shekhar Ghosh, the MD and CEO of Bandhan Bank at 9:40 a.m. He'll be detailing the last quarter's numbers. Well, let's move on then. ONGC is another stock that's in focus. Sonal joins us to tell us exactly why. Morning, Sonal.
Good morning, Nigel. Well, after a break of 2 months, the government has gone ahead. They've increased the windfall tax on crude oil production by 1,600 rupees per ton. This, of course, is versus the nil figure that we had earlier. And this has happened because we've seen crude oil prices inching higher. They were at a 3-month high. Today, they have come in for some profit taking. But this is because of the hike that we've seen. They were up 11% in last 2 weeks. However, the special additional excise duty on petrol, diesel and ETF continues to be nil. But ONGC will be in focus because on crude oil production, it has been increased now.
Okay, thanks a lot for that. Well, Ekta is also with us to tell us about some of the other earnings that came through. There was Metropolis, Unichem, Kesoram Industries. Ekta, how did it look?
Thanks for that. Well, I'll start with Metropolis, which I expect that stock to be in the red because they've come up with their Q1 FY24 update. They've said that revenue is expected to be marginally negative due to COVID, as well as a B2G contract, which is a business to government contract, which was insourced by the government in the previous quarter. Q1 margins seasonally weakest for companies with large market share in the West due to summer holidays. They expect lowest margins in the financial year due to lower revenue growth plus marginal cost increase. Plus, they will be impacted by the insourcing of the B2G contracts. So they are negative in terms of the margin picture for this quarter. Positives for Metropolis: core business revenue growth at 12%, premium wellness segment has grown 23%, gross debt at around 67 crores. So maybe that would negate a little bit of the pain which they have indicated in terms of the margins. Unichem and IPCA, I expect both these stocks to be in the green because Unichem has come out with a good number and IPCA is going to be acquiring Unichem. So revenue up 37% year-on-year, EBITDA 28 crores versus a loss on a year-on-year basis. Loss has reduced to around 66.8 lakhs. And Q1Q as well, the margins have improved to 6.6 versus 4.1%, and the loss again has reduced on a Q1Q basis. Remember, there was an exceptional last quarter of around 30 odd crores. Kesoram, expect the stock to be in the green because the net loss is reduced to 32 crores versus a loss of around 61 crores year-on-year. Revenue is up 12% year-on-year.
All right, thanks a lot for that. Well, a couple of more stocks in focus, and Surbhi is here with us in the studio to talk about that. There's AngelOne, there's Varroc Engineering. Surbhi, take it away.
Thanks so much for that. So for AngelOne, the news is that NSE has filed an order against the company, and they say this is they failed to monitor the operations of its authorized persons. They've also issued a monetary penalty of nearly 1.6 crores against the company. They've prohibited from onboarding any new APs for a period of at least 6 months, and also AngelOne has to conduct an inspection of all its APs and submit a report to the exchange within the next 6 months. For Varroc Engineering, they have revised the deal with the French company, and now Varroc Engineering will receive 13 million euros in their escrow account versus 28 million euros earlier. Now, just to give you some context on this, in April of 2022, the company had entered into an agreement with the French company to divest its four-wheeler business in the Americas and the Europe region. In October of 2022, the deal price was revised downwards to 520 million euros from 600 earlier, and also the escrow was revised downwards to 28 from 35 earlier. So now it's further reduced to 13 million euros from 28. So expect some red on that.
Thanks a lot for that, Surbhi. Well, let's do a quick recap then of all the top stocks that we just highlighted for you. The ones with positive news flow include Just Style, Unichem and Kesoram Industries. While the remaining list, well, they'll be reacting to negative news flow. That includes Avenue Supermarts, JSW Energy, Bandhan Bank, ONGC, Metropolis, AngelOne and Varroc Engineering.
Okay, well, we'll take a very quick commercial break here, but Prakash Devan will be with us for some stock talk on the other side of this quick commercial break. Stay with us.